Billionaire Ray Dalio, who correctly predicted the 2008 financial crisis, just called Trump's tariffs very disruptive and compared them to throwing rocks into the production system. That's right, the same investor who saw the last economic collapse coming is now raising red flags about our current situation and saying we could be headed for something much worse than recession. In this video, I'm going to break down exactly why Dalio and 62% of American CEOs are expecting a recession within the next 6 months. We'll examine how Trump's tariffs combined with mass DOGE layoffs might be creating the perfect storm for an economic downturn, and more importantly, what this means for your investments right now. Ever wondered if the financial talking heads are steering you wrong about Trump tariffs? Well, the truth is, while everyone's panicking, the smart money is quietly positioning for opportunity, and what's happening right now in the markets could be the perfect contrarian setup if you're willing to look where others aren't. You see, the S&P 500 just took a dramatic dive, briefly entering bear market territory with a 20% decline from its recent high, and that's not just a statistic. It represents approximately $10 trillion in market value that's been completely erased. Most investors see this as reason to run for the hills, but contrarian investors see it differently. They see quality companies suddenly trading at discounted prices, created potential bargains that haven't been available for years. Now, market volatility reached levels we haven't seen since the early pandemic days of April 2020, and the VIX, or CBOE volatility index, has spiked dramatically, reflecting the fear gripping Wall Street. And this surge in the fear gauge typically signals maximum uncertainty, which is exactly when contrarian investors start getting interested. Why is that? Well, because emotional market reactions often lead to mispricing, and mispricing leads to opportunity. You see, the current market reaction isn't just about uncertainty, it's specifically about the impact of tariffs and their potential to disrupt business as usual. Goldman Sachs CEO David Solomon didn't mince words when he said the prospect of a recession has increased due to these trade war uncertainties, and CEOs and institutional investors alike are hesitant to make important decisions, which is creating a slowdown before the actual economic impact has even materialized. And this hesitancy creates opportunity. Consider sectors that stand to benefit from tariff protection. For example, domestic manufacturing, steel, and aluminum producers might actually see competitive advantages as imports become more expensive, which means companies with primarily domestic supply chains could outperform those heavily dependent on international logistics. Now, the market hasn't fully priced in these nuances yet. It's still in sell everything mode. And what's particularly interesting about the current situation is how the tariffs are creating a unique economic environment. You see, the average tariff rate on US imports could potentially jump from around 2.5% to 25% or higher, and this isn't just an abstract policy change, it fundamentally alters the competitive landscape for thousands of businesses, and the winners will be those who can adapt their operations or who already have domestic-focused business models. Now, the Federal Reserve faces an especially challenging predicament because they're caught between concerns about inflation as well as the risk of triggering a recession through policy missteps. And with tariffs potentially adding a percentage point or more to headline inflation, the Fed might find itself sidelined at the worst possible moment, unable to stimulate a weakening economy because of tariff-driven price increases. And smart money knows that market reactions to tariffs aren't new. Previous implementations have followed a very predictable pattern. Initially, panic selling, followed by a more nuanced reassessment as investors identify which businesses are actually positioned to benefit. And those who can identify the sectors and companies that will thrive under the new rules before mainstream sentiment shifts could see substantial gains. Now, the truth is the coming market rotation might benefit those positioned correctly before the masses actually catch on. Areas like domestic manufacturing, infrastructure, as well as companies with pricing power could see renewed interest once the initial shockwave wears off. Meanwhile, quality companies caught in the crossfire of indiscriminate selling might present rare buying opportunities for those with the courage to act when sentiment is at its worst. And while Wall Street analysts and economists fear Trump's tariffs as recession triggers, contrarian investors recognize them as potential wealth creation catalysts if you know exactly where to look. And the key isn't predicting whether tariffs are good or bad for the economy as a whole. It's actually identifying which specific segments will benefit and which will struggle, then positioning yourself accordingly before consensus catches up. And one request I have is if you're enjoying this content so far, please hit the like button for the algorithm and consider subscribing to the channel if you're enjoying this. We put out weekly content on the latest economic news, and it's very time consuming and it's a lot of work, but your support in liking and subscribing the content makes it worth all the effort, and it is much appreciated. And while the market might be focused on picking winners and losers from Trump tariffs, Ray Dalio is actually connecting the dots that paints a much darker picture. The billionaire founder of Bridgewater Associates is signaling what could be a fundamental breakdown of the existing world order. And when someone who correctly predicted the 2008 financial crisis starts raising red flags, investors who want to protect their wealth should be paying close attention to what he's actually saying. You see, Dalio warns about several interconnected factors creating a perfect storm. US debt reaching unsustainable levels, widening budget deficits, which are straining fiscal resources, as well as escalating geopolitical tensions, which are creating instability on a global level. And in his assessment, these forces working together could create something much worse than a recession. He draws direct parallels to the market crises of 1971 and 2008, but suggests that the current situation could be more severe than those if other matters occur simultaneously. And buried within Dalio's warnings are clues about which assets might thrive in this environment. You see, throughout previous major economic shifts, Bridgewater's Pure Alpha Fund delivered exceptional returns by positioning ahead of market consensus. During the 2008 financial crisis, Dalio's flagship fund posted a 9.5% gain through strategic positioning, and his economic machine framework identifies 5 key forces: the money credit debt cycle, internal conflict, world order shifts, acts of nature, as well as technology. And when these forces fall out of harmony, economic disarray follows, creating opportunity. Now, Trump's policies function as a catalyst, disrupting multiple interconnected systems simultaneously. And for average investors, Dalio's framework translates to very simple and practical approaches. Number one is increase cash positions to provide protection and opportunity for when markets correct. Number two is add modest allocations to gold ETFs as well as treasuries as portfolio insurance against currency devaluation. And 3, focus on companies with a strong balance sheet and essential products or services. Defense-oriented sectors often demonstrate resilience during uncertainty, as well as sectors like healthcare, consumer staples, utilities, as well as select technology companies with minimal supply chain exposure. These all represent potential safe harbors, and consider value over growth, particularly companies with pricing power and lower debt levels. And what makes Dalio's warning especially significant is its emphasis on systemic factors rather than isolated indicators. He describes monetary policy challenges, fiscal problems, and geopolitical tensions converging simultaneously. And the silver lining is that this level of market dislocation typically creates extraordinary buying opportunities for those with available capital as well as strategic patience. And that silver lining that Dalio hinted at is happening right now in specific market sectors. You see, when tariffs reshape supply chains while government payrolls simultaneously contract, the resulting economic environment doesn't match historical recession patterns. This actually creates a rare asymmetric betting opportunity for investors who understand what happens when these forces collide. What do trade wars and massive job cuts have in common? They're creating a distinctive economic pattern with unique winners and losers. And the numbers reveal that 62% of CEOs right now are predicting a recession within the next 6 months. And this level of pessimism creates significant market inefficiencies, also known as a disconnect between perception and reality that savvy investors can exploit. On one side, Trump's tariffs are injecting uncertainty into global trade relationships and potentially increasing costs for imported goods. And on the other side, Trump's DOGE initiatives threaten what the Economic Times called the largest job cut in American history by a mile. And together, they're reshaping an entire investment landscape. You see, government efficiency measures impact sectors unevenly. When federal spending contracts, companies heavily reliant on government contracts feel immediate pain. So this is things like defense contractors, IT service providers, and construction firms. However, private sector alternatives often see increased demand as resources and talent flow away from government work. Meanwhile, tariffs force dramatic supply chain restructuring, and companies that are dependent on cheap imports scramble to find domestic alternatives, meanwhile creating winners in unexpected places, and industries with domestic manufacturing capabilities suddenly gain pricing power that they haven't enjoyed in decades. Now, this combination of reduced government spending with tariff-induced inflation creates conditions similar to stagflation, which is slow growth paired with rising prices, and this breaks traditional recession playbooks. Sectors with pricing power like consumer staples and healthcare historically outperform during these periods. So building a recession-resistant portfolio requires balancing defensive positioning with opportunistic allocation as well. Start with quality companies with strong balance sheets, low debt, and proven ability to maintain margins during inflationary periods. Add selective exposure to domestic manufacturers positioned to capture market share from tariff-affected foreign competitors. competitors. And the sweet spot for contrarian investors lies at the intersection of infrastructure-focused investments, domestic manufacturing, as well as companies with pricing power. Most importantly, maintain strategic cash reserves for when quality assets become temporarily undervalued due to market turbulence, and those with capital available when others lack it will often capitalize most effectively on this unique economic scenario, also known as buying the dip. And the economic chess match between tariffs and job cuts just gained another player, the Federal Reserve. Did you know the Fed's cautious whispers can actually be your green light for profit? Right now, their sudden dovish pivot confirms recession fears while also creating a secret playbook for investors who understand how monetary policy reshapes market sectors during economic uncertainty. You see, when the Federal Reserve shifts to a dovish stance, meaning they're lowering interest rates, they're essentially waving a yellow caution flag at the entire economy, and this same yellow flag has historically signaled green for specific market sectors, and the Fed's recent statements revealed genuine concern about economic slowdown, explaining their willingness to ease monetary policy through potential rate cuts or pausing hikes. And when the Fed cuts rates, money becomes cheaper to borrow, which means that it recharges certain sectors. So interest rate sensitive sectors like technology and consumer discretionary spending typically experience meaningful gains, as well as tech companies are valued based on future earnings, and lower rates makes those future profits more valuable today. This is why consumer discretionary benefits as cheaper borrowing stimulates spending. Now, the Fed's current policy dilemma has them caught between fighting inflation and preventing recession, and their pivot to accommodation creates a roadmap for strategic investors because during previous Fed policy pivots, technology stocks have consistently outperformed the broader market. Real estate investments also thrive when borrowing costs decrease, and lower mortgage rates boost housing demand, benefiting homebuilders as well as REITs. Clear correlations exist between Fed easing cycles and outperformance in these specific sectors, and the Fed put provides another edge, an unwritten market expectation that the Federal Reserve will intervene during significant downturns. As Jerome Powell noted, there's a lot of waiting and seeing going on, including by us, and that just seems like the right thing to do at a time of elevated uncertainty. This is why the waiting game creates opportunity for well-positioned investors. And for your investment strategy, consider allocating to interest rate sensitive assets, technology stocks, and long-term bonds. Balance these with inflation hedges like select commodities or real estate to protect purchasing power, specifically focusing on technology companies with strong cash positions and limited debt, or consumer discretionary firms with pricing power as well as loyal customers, in addition to real estate investments in growth areas that are less dependent on government spending. So by analyzing the Fed statements, policy decisions, as well as economic data, you can position your portfolio to capitalize on these shifts before mainstream investors catch on. The Fed's dovish stance creates a blueprint for sector rotation and potential profit for those who are paying attention. So what's the real takeaway from all the chaos? While most investors panic at the mention of recession, historical data tells a different story. From 1869 to 2018, there were 16 recessions with positive stock market returns, averaging 9.8% gains even as GDP declined. The smart money isn't wasting its time trying to predict exactly when or how severe a downturn might be. Instead, they focus on building a portfolio designed to capitalize on market inefficiencies created by fear. The convergence of tariffs, government restructuring, and the Fed's cautious stance creates the perfect environment for contrarian investors. And your mission isn't to dodge a recession. Instead, it's to position yourself to profit from one. So if you enjoyed this content, please hit the like button for the algorithm to stay up to date on the latest economic trends, and we will catch you on the next episode.